Welcome, everyone, to today's show. It's Crypto Tuesday, September 21st, the year of our Lord 2021. So welcome to the show. We're going to talk about the regulation war, tax and regulation war that's going on about crypto. It's going on right now. We're all part of it. So join us, won't you? Thanks so much for joining us today. It's Crypto Tuesday. As I mentioned, always a fun day for us here. Good news. I know crypto's been going very volatile. What's new, right? It's always volatile. It's the way it works. But as I've been talking a lot about the IRS and their war on individuals, entrepreneurs, cryptocurrency, the tax gap, millionaires and billionaires. We keep hearing about this out there, and I look like I misspelled crypto. That's what happens when you're in a hurry. But anyway, this is what happens. The IRS is coming after. They're coming up with new ways. We talked about the wash sale rule. We talked about many of these benefits that used to be on crypto and where they're going now. So let's. I got a great story that's going to kind of sum it all up for us. So let's go right into it. So cryptocurrency tax war. Do you trade Bitcoin? You better know about wash sales, which we talked about here, constructive sales, and straddles. And so that's because they're changing the rules, right? The first part of the assault on virtual currency has the Internal Revenue Service going after tax cheats, successful traders who neglect to pay tax on their gains. It involves threatening letters, grabs of customer records from exchanges. And again, that's going to be more and more prevalent. And no doubt plans to make public examples for some of the big offenders. They're already doing that. They're putting many people. I read many stories of the crypto exchanges or some people with fraud that they're putting in prison. There's no bigger than John McAfee. There's no bigger example of that. The second part of the crypto war targets honest investors. The government wants to make it harder for you to claim a loss and easier for you to be forced to declare a gain. Again, there's nothing wrong with that. Right now, what they're saying is evil is perfectly legal. And that's what they're trying to change. They're trying to change the nature of some of these events. Part two is, for the most part, a work in progress. The tax increase under the debate in Congress would extend the rules on wash sales and constructive sales, which now apply only to things like stocks and bonds, to other investments like commodities, currency, and digital assets. So, they're reluctant to raise the percentage, the tax rate on certain things. But what they start doing then is start disallowing deductions and changing the rules that way. So your income goes up, even though they haven't really changed the tax rate. You wind up paying a lot more taxes. That's the goal here. So they can say, well, we didn't really raise taxes. Yes, you did. You just did it in a different way. The two objects spell out defensive maneuvers. It is the open question whether the Biden administration can pull together the votes for the tax hike intended to raise $2 trillion over a decade, even though they're spending $3.5 trillion. But it is quite likely that the crackdown on crypto will sooner or later find its way into the statute books, simply because crypto players are perceived as benefiting undeservedly from existing tax law. And again, nobody's taking in. They're not accusing anybody of illegality or anything like that. They're just saying that the rules are not fair, and how dare you take advantage of rules that benefit you, right? There's been too much publicity about the loopholes in magazines like yours. In short, even Republicans might sign off on a crackdown, as they did recently in inherited IRAs. It pays to be prepared for a tougher go on your 1040. Well, I agree. I think that they just capitulate too longer. They call it evil when it's really not. The money is really yours, and they're trying to find ways to make it theirs more and more ways. The battle between congressional tax writers and clever investors goes back to a century, to Section 1091 of the tax code, the wash sale rule. This law says you can't deduct a capital loss on a stock if you buy the stock back near the time that your loss sale. More precisely, your loss is suspended if you buy replacement shares within 61 days window beginning 30 days before the loss trade. Example, you buy 100 Tesla at 800, see it drop to 600. You want to claim a $20,000 capital loss while maintaining your exposure so that you don't miss out on the rebound. If you double down your position, then sell the original shares a week later, you can't claim a loss on them. Instead, the $20,000 gets added to the cost of the replacement shares. The effect is to leave you where you would have been if you stood pat. Under present law, the wash sale rule does not apply to cryptocurrencies, and that means cryptocurrency investors can turn the considerable volatility in the market into immediately tax benefits. And here's what my advice is to people, right? You should. That's what the law allows, and you should use it for your advantage, right? That's what could be the difference between being successful and not being successful, using the laws correctly. Again, I tell people this all the time about structuring their business right. You want to structure your business to pay the least amount of taxes legally. Nothing illegal about it. Just like these, until they change the rules, you should take advantage of the rules. And the only way you can take advantage of the rules is to know what they are. They can periodically book tax losses on recent purchases without really altering their position. Enjoy this feature of crypto while you can. If you aren't already harvesting losses from a crypto portfolio, start now. As I just mentioned, take advantage of these rules. The pending tax bill would apply the wash sale limitation to trades occurring after December 31st. So take advantage of them now. The volatility just crashed again. Take advantage of it. Sell your crypto and buy it back, and you can take the loss. After this or other legislation takes effect, there will still be a way to capture losses while participating in market rebounds. Section 1091 says you're in trouble only if the replacement property is substantially identical to what you're selling at the loss. When is one investment substantially identical to another? That is not defined precisely. The IRS would presumably insist that Bitcoin is substantially identical to a Bitcoin exchange trade fund. That's true. And I think they would say that many of they just came out with a ruling about this not too long ago about if you can replace it or not with other crypto coins. And they say it's substantially similar. I think that's the position that they will hold. Thus, it would not be a good idea to sell Bitcoins at a loss and then immediately buy Bitcoin ETF. Again, I don't think it would make sense to even, if there's a lost sale rule, to buy even any other crypto at the time. What if you used as a replacement for coin stake shares in Grayscale Bitcoin Trust? This is not an ETF. It's more like a closed-end fund. The tax collector might or might not prevail here. You could argue that owning trust shares, which is in the past year have swung from a fat premium over their coin value to a recent 15% discount, is not identical to owning the Bitcoin. I could guarantee the IRS will take the position that it's substantially similar. But you don't need to take a gamble on this unanswered legal question. There's another way to maintain a temporary stake in crypto for your replacement property. Buy Grayscale Digital Large Cap Funds. This fund, 65% invested in Bitcoin and 20% in Ethereum, is decidedly unlike either of one of those coins. I don't know if that's true. After 31 days, you could rid yourself of the fund and its stiff 2.5% annual expense and reestablish your Bitcoin position. Now, these harvested losses are particularly useful only if you have capital gains elsewhere in your investing life. That's true, right? If I sell and I take a loss, that's a capital loss, and I can only offset my capital gain unless I can do up to $3,000 a year. But if there's substantially more than that, and I'm selling other assets with capital gains, then that would offset those capital gains. They come in with a potential tax loss. You wind up with a lower cost basis for your digital assets, meaning a higher gain to report down the road. But that gain may occur years later or perhaps never. Under present law, you can avoid recognizing the gain on assets given away or left at your estate. An elimination of the estate freebie, which goes by the name of setup and basis, was at one point part of the Biden tax plan, but is not at the moment it's not part of the legislation. Well, good. That would be a devastating effect of the change of the tax law that I don't think most people would realize until it's too late. And they're doing a lot of this creative tax raising. So they can say, well, see, we didn't raise your taxes, but you did raise my taxes. The warfare over trading tricks did not end with the wash sale law. In 97, Congress added to the code constructive sales. This was aimed at investors who use hedges, such as short sales or futures, to lock in gains without selling an appreciated asset. The law forces the hedger to report the gain and cough up a tax on it immediately. Section 1259 does not apply to digital assets, so you could effectively cash out on a winning Bitcoin bet without owing taxes. Hypothetically, you own 100 million of Bitcoin with zero basis. Sell the Bitcoin short, borrow 99 million in real cash against the hedged position. Buy whatever you want with the money and never pay tax. At death, there will probably be a step up in basis. Nice, but don't count on it. For the same reason that crypto wash sales are likely to get nailed, the short selling game is probably doomed. There's a third weapon in the IRS anti-trader arsenal. It has to do with straddles, which are investments that involve simultaneously long and short bets on a financial asset. In 81, Congress enacted another section, 1092, which says that if you have a pair of offsetting positions, you can't book a tax loss on the losing side until you've closed out the winning side. Also, the holding period on the winning position gets suspended, so you can't use a hedge to transform a short-term gain into a long-term gain. Section 1092 was originally aimed at rampant tax mischief involving Treasury bill futures, but it's a sweeping statute covering all manner of assets and all sorts of hedges, including put options. It reaches virtual currencies, even though they didn't exist until 30 years after the law's enactment. Digital asset traders have to pay careful attention to the anti-straddle rules. Among the pitfalls, when you combine a position in Bitcoins or a Bitcoin fund with an opposite position in Bitcoin futures, you wind up with a dreadful concoction known as a mixed straddle. Okay, so how do you hedge? I'm not going to get into all of that, but this is an interesting article because it shows us what they're trying to do, and maybe again. In order to take advantage of a lot of these rules, you need to know what they are. And this is what tax planning is all about. This is what we help people do at Open Tax Advocates, right? Tax planning, tax preparation, setting things up correctly is the key. Understanding the rules really is the key. So it's not really getting around the rules. It's applying the rules as written. They may change, but they haven't changed yet. You can still take advantage of these rules. So if you want to take advantage of some of these rules, you should give us a call at Open Tax Advocates, 312-664-6649. Again, it's 312-664-6649. Remember, if you are having some tax problems, the IRS is coming after you. I wrote a book. It's called Deal with Your IRS Problem Today. Deal with your IRS problem. Go to freeirsbook.com. freeirsbook.com. Get yourself a copy. And please like and share and subscribe if you're on Facebook. Like if you're on YouTube. So subscribe. If you
Welcome
subscribe,
everyone to today's show.
So we know that
it's Crypto Tuesday.
I want to thank you so much.
September 21st, the year of our Lord, 2021.
Time.
So welcome to the show.
If I can pull this up quickly.
We're going to talk about the regulation war, tax and regulation war.
Then we can sign off. So thanks so much for joining us here today, Crypto Tuesday. We'll be back tomorrow, and I hope you join us there at that time. Have a great day.